Today we're talking about tax information and transparency and how tax authorities are getting more creative than ever at putting all the important pieces together. We dive into a new study that reveals how companies are responding with some surprising tactics of their own. Stefan Richter is an assistant professor of accountancy at Geese College of Business. He's co-authored a paper on this very topic and he joins us today. Stefan, we're talking about the tax information contained in corporate reports. They're supposed to be transparent, but they're also used by tax authorities. So set the scene for us. What kind of corporate reports are we talking about here, and what exactly are these tax authorities looking for when they read these reports?
Thanks, Aaron. When we talk about corporate tax disclosures, we're really referring to the income tax footnote that appears in firms' annual reports. These are the 10K filings that public companies are required to make with the SEC each year. These footnotes are meant to help investors understand a company's tax situation. So, for example, the companies will disclose why their tax rate in the financial statements is differing from the 21% U.S. statutory tax rate, or how uncertain tax positions might affect the firm's future taxes. What's interesting is that these same disclosures are also available to tax authorities, so federal, state, or even foreign authorities. So while they're designed to provide information to investors, they can also be used by tax authorities to identify red flags or inconsistencies. That creates a fundamental trade-off. Managers have to provide enough information to comply with disclosure requirements and also satisfy investors' demand for this information, while being careful not to reveal too much information to tax authorities who could use that information to challenge the company's tax positions.
So there's an incentive to reduce transparency of the corporate reports, and that's what this paper is looking at, specifically the tax footnotes. First off, these are publicly traded companies, the ones that everyday people can invest in. They have to disclose certain tax information. It's the law, and that information gets put into these footnotes. You and your co-authors got exclusive access to 27 tax executives, the people who actually write these footnotes. These are executives from both big and small companies, different industries, and different levels of experience, from 10 years to more than 40 years. And one thing that really jumped out, almost 90% of them said tax authorities are getting really creative, looking beyond the usual tax returns.
You're right. Almost every executive we spoke with said that tax authorities, especially the IRS, are obtaining information from public sources. The rich context of these interviews allows us to gain an understanding of what type of information these agents are gathering. These tax authorities are getting much more creative about using public information by looking beyond just downloading the 10Ks from SEC's EDGAR's website, which we know from prior research. For example, these authorities are also checking conference call transcripts, even monitoring company websites, and reviewing press releases. Another novel insight is that these executives emphasize the use of public disclosures really depends on the individual tax agent and the country involved. Skilled agents, particularly those in the U.S. and other sophisticated tax administrations, are much more likely to dig into this public information. In contrast, these executives said that agents in some other jurisdictions, such as where English proficiency or resources are lower, tend to rely less on SEC filings and more on local sources like regional company websites and translated materials.
They're digging into those public disclosures, the 10Ks, earnings calls, trying to connect the dots and put together a complete puzzle using all of these public pieces of information. And some even admitted to checking out executives' LinkedIn profiles.
It sounds surprising, but yes, we heard that tax authorities have looked at things like employees' LinkedIn profiles to assess where around the world the company's operations are being conducted, which can matter for transfer pricing purposes. Others mention that auditors have referenced media articles or even slides from industry conferences and have asked the tax executives about information in these resources. So tax executives have become very aware that anything posted publicly could become part of the tax audit. They're realizing that the digital footprint of the company and even of individual employees can be used to challenge where income should be taxed. That's changed how some of them think about disclosure and communication in general.
It really shows how valuable all that publicly available information is becoming. And now companies are responding with some strategies of their own. One that came up a lot was vagueness, being deliberately unclear. They have to disclose certain things, but they do it in a way that reveals as little as possible. making it hard for the tax authorities to decipher what's really going on.
Exactly. The executives describe what we call strategic minimization, being compliant, but deliberately reducing the usefulness of the information. They'll meet the disclosure requirements, but they'll do it in a way that provides as little usable information as possible to these tax authorities. So, for example, instead of listing the exact countries where subsidiaries operate, they might just say various foreign jurisdictions. Or instead of explaining the details of a recent large tax settlement, they'll summarize it in broad terms. The goal isn't to mislead, it's to reduce the usefulness of the information to tax authorities who might otherwise use it to target or extend an audit.
So they're ticking the boxes, but also keeping things fuzzy. It's clever, but risky. It's all a balancing act. They have to keep investors happy, but also try to throw the tax authorities off the scent. So does this strategic minimization actually work? That's what you wanted to know. And you didn't just stop at interviews. You analyzed tons of these tax footnotes going back years. What did you find?
You're right. So we complemented our interviews with some statistical analyses. So we took these insights from the interviews and we wanted to see if they held up in the data. When we analyzed over 15,000 tax footnotes from 2011 to 2021, we found a clear pattern. Firms facing higher exposure to tax authorities, to those with larger international footprints, those with lower effective tax rates, or those with recent tax settlements, tend to write more vague tax footnotes. So the executive words match the data. We can actually see the strategic minimization show up in the large sample evidence. The language of the tax footnotes become less precise as the potential tax costs of disclosure rise.
So you would say they're not purposely trying to hide information, but some are pushing the boundaries within limits. And the ones with big global operations, they were more likely to be vague too, right? Because they have an incentive to keep things under wraps because of tax planning that goes on when a firm operates in many jurisdictions. But that raises the question, what does this mean for investors? Are they missing out on crucial information because of this deliberate vagueness? You focused on financial analysts, the ones who are supposed to connect the dots, to see if they could predict a company's future taxes based on how clear or unclear the tax footnotes were. So it's like a test to see if the vagueness actually throws them off. And maybe surprisingly, you found the vagueness didn't seem to affect the analysts.
Yeah, you're right. So we want to test whether this vagueness actually hurts investors. And so we do so by using these analysts, the people who are most likely to read these disclosures and forecast future taxes. What we found is that these analysts weren't any worse at predicting taxes for firms with more vague footnotes. In other words, the vagueness didn't seem to impair their forecasts. What's interesting is that this lines up closely with what several of the tax executives themselves told us during the interviews. Many said they don't think investors or analysts spend that much time in the tax footnote. They mentioned that analysts really care about the projected effective tax rate, but not necessarily the narrative details. So when managers make these disclosures less useful to limit what tax authorities can learn, the executives don't see it as a trade-off, as ones that could negatively impact the investors or the analysts. Our data supports that view that these strategic disclosures do not appear to harm market participants.
Now, there's another layer to this story, the SEC, the Securities and Exchange Commission, the watchdog. They're not going to be too happy about all this vagueness, and they can issue comment letters, basically saying, hey, this isn't clear enough, explain yourselves. So there's a limit to how vague companies can be. They can't just hide everything. And you found out the more vague the footnote, the more likely these companies were to hear from the SEC.
Exactly. So the one place where vagueness does seem to have consequences is with the SEC. We found that companies with more vague tax footnotes are significantly more likely to receive a tax-related SEC comment letter asking for clarification or additional disclosure. But interesting, after receiving a comment letter, we didn't find that firms changed their disclosure behavior. In other words, the vagueness of future disclosures didn't seem to be impacted by the receipt of a comment letter. So overall, while the SEC may question the disclosure, the broader costs remain limited.
So what do you think the biggest takeaways are?
I think we have three main takeaways. So first, our evidence opens up the black box into how tax footnotes are actually written. By talking directly with executives who prepare them, we show how they balance complying with disclosure rules while trying not to reveal too much information to tax authorities. Second, we find that the strategic minimization doesn't appear to harm investors. Analysts are just as accurate in forecasting taxes for firms with vague footnotes, which matches what executives told us. they don't think analysts rely much on these details anyways. So our insights and findings challenge a prevailing assumption that this disclosure behavior adversely affects financial statement users. And finally, the main cost of being vague seems to be regulatory in nature, not market-based. So firms with more vague footnotes are more likely to receive an SEC comment letter, but the broader cost of these disclosure choices does appear to be limited. So overall, our paper moves the conversation from whether firms respond to propriety costs to how they do it and what those choices actually mean for investors and regulators.
That is Assistant Professor of Accountancy Stefan Richter. The paper is called Strategic Minimization in Income Tax Footnotes. You can read more about research like this coming out of Gies College of Business at giesbusiness.illinois.edu. Thanks for listening, and we'll talk to you next time.